Welcome to The Explainer. Today, we're breaking down a really fascinating options strategy called the call ratio backspread. Now, this is a high-stakes play. It's not for when you're just kind of optimistic. It's designed for when you have absolute, rock-solid conviction.
So let's just start with a question that gets right to the point. What if I told you there was a trade that offered literally unlimited profit potential, and you actually got paid just for opening the position? I know, it sounds a little too good to be true, but that's exactly the idea we're going to unpack today. Okay, so take a look at this. On the left, you've got your typical bullish bet. You know the drill. You pay money up front, and your potential profit has a ceiling. But the ratio backspread on the right, it completely flips the script. You can start with cash in your account, and your upside is, well, limitless. It's a totally different ballgame for a bullish outlook. However, and you knew there was going to be a however, right? This incredible potential comes with a very specific and pretty dangerous catch. There is a sweet spot, a zone, where this trade can go very, very wrong. And you absolutely have to understand that risk before you even think about touching this. This all leads us to the central paradox of this whole thing. How on earth can a trade offer so much upside while paying you to get in? The answer is all about conviction. This isn't a strategy for being vaguely optimistic. It's for when you are absolutely certain the market is about to make a huge move. You know, this quote just nails the mindset perfectly. This strategy is basically designed to weed out the casual bets. It demands a super high degree of certainty, and if you're right, boy, does it reward that conviction in a way that very few other strategies can. So, how is this thing actually built? Let's peel back the layers and look at its anatomy, because the real magic is all in this unique 2-for-1 ratio. At its heart, it's a 3-part strategy built on a simple 2-for-1 structure. What you do is, you sell one in the money call, that's the one that already has some real value, and you use the cash you get from that to buy 2 cheaper out of the money calls. Those only become valuable if the price really starts to climb. It's this imbalance that creates the whole effect. And here's how that works with some actual numbers. Check this out. You sell the 7,600 call, and boom, 201 rupees land in your account. Then you turn around and buy 2 of the 7,800 calls for 78 rupees apiece, which costs you 156. You do the quick math, and what's left over? A net credit of 45 rupees. You literally get paid to put the trade on. All right, now for the most important part, the payoff graph. This is not your boring straight line. It's got this wild V shape with 3 very distinct zones. A zone where you win, a zone where you hit your maximum loss, and then another zone where you start winning again, this time with no limit. So let's start with the first surprise. Let's say your bullish bet is just completely, totally wrong and the market tanks. All the options expire worthless. And guess what? You still make money. You just get to keep that initial 45 rupee credit as your profit. You actually win by being wrong in the opposite direction. But here it is. This is the danger zone. If the market just kind of moves up a little and then stalls out, landing right around the strike price of the calls you bought, that's when you hit your maximum loss. This is the valley of risk that you have to be willing to cross. But if your conviction was right, if the market doesn't just move, it soars. Well, once you blast past your upper break-even point, your profit potential is truly unlimited. For every single point the market goes up from there, you make more money with absolutely no ceiling. This table really maps out the entire journey of the trade for you. You can see the small profit if the market falls. You can see that clearly defined max loss right there in the middle. But then look what happens once you get past that 7,955 break-even point. The profits just start to accelerate like crazy. It's the whole roadmap right there. All right, let's dig into a more advanced idea here. Something that can really make or break this trade. Volatility. And its impact isn't quite as simple as you might think. So why is timing so critical with volatility? Well, early on, a spike in volatility is your best friend. It helps out your 2 long calls more than it hurts your single short call. But late in the cycle, when you're getting close to expiration, that advantage disappears. A volatility spike can actually start to work against you. So, knowing all of this, what are the exact conditions you should be looking for? When is it the right moment to pull this powerful and kinda dangerous weapon out of your trading toolbox? Think of this as your pre-flight checklist. First, you need that absolute conviction on the direction. Second, there needs to be a clear reason, a catalyst, like an earnings report or a big announcement. And the perfect setup? Implied volatility is low, but you expect it to rise, and you're still early in the expiration cycle. If you can't take all those boxes,
Honestly, a simpler strategy is probably a much better bet.
And this is really the ultimate takeaway here. This is not a strategy you use for some vague, general, bullish feeling. No way. This is a precision instrument. It's designed for a specific, event-driven move that you are highly confident is going to push the market decisively through that danger zone.
And all of this brings us to the final, critical question you have to ask yourself before you ever place this trade. You know exactly where the danger zone lies. You know exactly what it will cost you if the market stalls out in that valley of maximum loss. So the only question left is your conviction strong enough to get you across to the other side?